Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast. I'm your host, Billy Keels, and today we have a very, very special show for you. If you've ever wanted to know more about how you can become involved or learn more around passive investing in real estate, this is absolutely the show that you are going to want to listen to more than once. You're going to want to watch it more than once, because today we have none other than Marco Santarelli, who is here with us, and he's going to help to share and unlock some of those secrets for you. So I'm going to just thank you right up front, Marco, for joining. It's really a pleasure to have you with us today.
Billy, I'm honored to be on your show. Thanks for the invite. I'm looking forward to this.
Definitely. So there's so many things to talk about as an investor. You are a published author. You are an Inc. 5000 entrepreneur. You're the founder of Narada Real Estate Investments. Also, you Think Realty's Master Investor of the Year. You have your own top-rated podcast, which is Passive Real Estate Investing. And you are on a mission to positively impact 1 million lives. And so with all of these different things, there's a number of different decisions and steps that you've taken to get to this point in your journey as an entrepreneur, as a real estate investor. And Marco, I would love for you to talk to the Going Long listeners and viewers really about what have you done to get to this point in your journey?
Well, Billy, I mean, that's a big question, and we could probably talk about it for an hour. I think the biggest takeaway, though, is this, that at some point, everybody and most people who are successful at some point in their life realize that, hey, I need to take control of my destiny. Life is a journey, and at some point, you need to realize that you need to be clear and set goals as to what it is you want to achieve. You need to have this, what they call a big, hairy, audacious goal. And it could be unrealistic. It could be unattainable at first because it's just beyond you. It's something that you didn't think you could ever achieve. But for a lot of us, when we take those big goals and we break them down to smaller goals and smaller goals and smaller goals, and ultimately we have these action items that we can go through like a list and check them off, like check the boxes, we find that we take these baby steps to what we call in the US, eating the elephant. How do you eat an elephant? Well, one bite at a time, right? So part of it is goal setting, and part of it is just understanding you as a person. Are you an entrepreneur? Are you an investor? Are you a happy professional in a sales career or an executive in a company or whatever you're doing, but you want to build something on the side, something for yourself, for your family, for your children, to leave a legacy. When you have that passion and it's something that you really want to go after, then what you start to do is you start to make things happen that take you in that direction. And a big part of it for me, which I'm sure is part of it for you, Billy, and it will be for a lot of other people, is taking the time to educate yourself. That doesn't mean become an expert in the subject. You can become an expert if you want, but you need to learn enough to know what you need to do and the team of people you need to surround yourself with in order to become successful. It's like you look at Robert Kiyosaki. He doesn't do everything by himself. He's got a top-notch tax advisor. He's got a top-notch asset protection attorney. He works with a bunch of people who are finding investment opportunities for him to invest in. So he's not the one driving the streets looking for them. He's got people who bring the deals to him, and then he'll underwrite them and evaluate them. So he's got a team. So educate yourself, have goals, build your team, and when you create that framework around you, you can achieve virtually anything you want.
Fantastic. And it all starts with that big, hairy, audacious goal. Going from there, being able to break it down into bite-sized chunks, being able to find the right team, surrounding yourself with the team, and then being able to move forward that way. It's a lot of powerful information, actionable, just from the very beginning. And so, when you talk about looking at a team, right? And a lot of times we're thinking right now about, how do you get investing in a passive way? What are some of the things that we should be looking for when you talk about team? Like, who are some of the different team members that we should be thinking about?
Well, it depends what you're trying to do. If you are looking to be an investor, a passive investor, then I think in almost every single case, you need a financial advisor, someone who is top notch that could advise you and understands the asset classes that you want to invest in, whether it be real estate, stocks, mutual funds, private placements, and private equity investments, whatever it is. You need that tax advisor. You definitely need one or more attorneys, one being a business attorney, one being an asset protection attorney. Those are the key people. If you're looking for deals, then there are going to be one or more people that are what I call your acquisitions team. They're the people who are bringing you the deals, whether, again, it be real estate or something else. But they're the ones who are out there as your scouts bringing you the deals. They understand it. They might be investors in it. They may be the principals or the syndicators in those deals that are bringing them to you. But those are the types of people that you'll probably have more than one of. I call that your core group. Those are your core people. Mm-hmm. Beyond that, you're going to have secondary or ancillary team members, whether it be lenders, mortgage brokers, title companies, home inspectors, whatever it may be. Those are the people that you're going to have. And often those people are brought in by your primary team of people. So that's kind of the short answer to your question.
Okay, so you have the core team, and when you have the core team, you have your person that's going to help you with the finances. You also have a couple of people that are going to help you with the legal aspects, and it also seems like there's so that's the core team, and then they will call other team members off the bench, to use a sports analogy, more or less.
Because they work with them, they know those other people, they've dealt with them, they probably work with them on a regular basis. So that's not uncommon for people that you trust, that you're already working with, to bring in other people that they trust and that they highly recommend because they have a good experience and they have history with those other people. So you don't necessarily have to find everybody. You just have to find your core group, and they will often bring in the other people.
Okay, fantastic. And so, Marco, and a lot of times we talked about a concept, right? And we're also helping to educate the marketplace. I know this is one of the things that you absolutely love to do. And we're talking about passive investors, and we've also talked about active investors. Can you help us to understand, when you talk about the two, what is the difference between the passive investor versus the active investor?
Yeah, well, it's very simple. So if you're an active investor, that means you are, I like to figuratively say, rolling up your sleeves and getting involved in the work. You're getting your hands dirty. So if it's working with a company and being involved in a business, you might be involved, maybe not full-time, but in the operations of that business, or you're on the board of directors, or you're involved in a company because you're an investor in that company, a shareholder, a principal, whatever. Real estate is a great example. With active real estate investors, those are the people who like to find distressed properties or distressed owners, and these are the properties that need some work. So you, Billy, might find a good deal, a distressed property. You're going to go in with your crew, but you're going to do some work. You're going to clean it out, renovate it, put it back on the market. Maybe you're flipping it for a quick profit. Maybe you're holding it, but you're going to do the renovation work. If you're actively involved in that deal, you're an active investor. And that takes time, and a lot of times that time is really your sweat equity, and it can take capital. And usually as an active investor, you're putting in money and time. You're putting in your expertise with your brain, or your muscle, your brawn, if you're fixing and swinging a hammer and turning something around and bringing the value up in that. So that's active real estate investing. Some people do very well doing that, and other people struggle, and a lot of people even lose a lot of money because it is a very intense way to invest. It's capital intensive, it's time intensive, it's high risk, but the flip side of it, it can potentially bring higher rewards in the terms of what we call you're building equity. I forgot the term, forced equity. It's you're forcing the equity into the property by bringing the value up. The flip side of that, the other end of the spectrum, is passive investing. And that is where you're bringing the capital to invest, and you're relying on other people whether it be a syndicator or a fund manager, or someone who's putting together a group investment in an apartment complex or whatever it is, you are a silent investor that's participating and letting other people do the work, the day-to-day operations, and finding the deal, managing the deal, overseeing the deal, kind of like the stuff that you're getting involved in. With passive real estate investing, if you can do very, very well, but it requires very little of your time. The time that you usually put in is upfront with your due diligence and working with your team. But once the deal is in your portfolio, you've taken title, whether it's real estate or a business. Now you're just getting cash flows, whether it's monthly or quarterly or annually. You're just getting cash flow from that investment, and the equity or the value of that grows over time. So that's really the difference.
Okay. So one, when you're on the active side, you're really rolling up your sleeves, you're putting in both time and money. And when you're on the passive side, you're putting in time, you're really focusing more on due diligence, understanding the team that you're going to be working with and contributing capital to. And then from there, it's more, I guess sometimes we would talk about whether it's the monthly, quarterly, or annually, depending on what is the right thing for you. That's the mailbox money that a lot of times people talk about.
Exactly. It's mailbox money.
There you go. There you go. So now think about the passive side, right? Because I know that you in Nevada, that you tend to deal with lots of passive investors, and just really interested in understanding, when they're coming to you, what is the main problem that they're looking to have solved when they start contacting you?
The number one problem is that they're looking for good deals that they can invest in, and their problem is they lack time. They don't want to go through this big learning curve of having to become an expert real estate investor and having to learn how to identify the markets and how to identify the right neighborhoods to be in and how to find the right team people that they can vet and trust, not be ripped off from. They are busy professionals. Again, they're often like doctors, attorneys, lawyers, CPAs. They're busy executives, busy salespeople. They've got busy corporate jobs, and they have a family, and they've got their kids, and they want to spend time with them. And so their time to put towards learning something relatively new, which is investing of any kind, whether it being in businesses or real estate, is very difficult for them to do, right? And it's not that they don't want to do it. Maybe they do, but they just don't have the time. So they're busy professionals. That is the number one problem, is they're busy, but they know they need to, and they want to invest in deals or in real estate to create a passive income stream.
Okay, so they're really looking to create more capital for themselves. They don't have time, so they're time constrained, and they want to get expertise, but they don't have the time to do that. Okay, makes a lot of sense. And so then there's this concept that could be new for a lot of people. And when we talk about turnkey, if you also can maybe break that down for us a little bit, what that means.
Yeah, so I started marketing the crap out of that term back in 2004. So back in 2004, 2005, I started marketing turnkey real estate everywhere, very, very hard. This was before the days of bigger pockets, before the days of a lot of things, right? But the term was already out there. I didn't invent the term, but people were referring to certain types of properties as turnkey. And it meant different things to different people. And still to this day in 2020, there's no formal definition of what a turnkey real estate investment is. So for us, our definition in terms of raising the bar in the industry, it's properties that are either new or like new condition, so no deferred maintenance, in good markets, so markets that are either stable or growing, in good neighborhoods, which typically for us are B class, BB plus, A minus neighborhoods, good demographics. They are cash flow positive from day one. They are professionally managed with full service property management. They are tenant occupied, obviously, so that's where the positive cash flow comes from. So really, it's a property that you can, once you've done your selection and due diligence on the front end, you can close escrow, put it into your portfolio, and keep building your portfolio. And that property will be managed by the management company and generate passive income each and every month, every quarter, every year. And as time goes on, it creates wealth because the equity grows in that property through both appreciation and the amortization of the loan. So that is a turnkey investment for us. That is how we define it. and really it's kind of the most passive way to invest in real estate outside of investing in a REIT, a real estate investment trust, which is essentially investing in Wall Street in a fund that's being managed by other people. So technically speaking, you are a shareholder. You own paper, not the real estate. You own the real estate only through this fund as a shareholder. So that is the most passive form of true direct ownership in real estate.
Okay, fantastic. I appreciate you talking about that. There is one term that I'd like for you to hit on, because I think it's key for those that are watching and listening. You talked about, in your definition of turnkey, the types of assets typically won't have deferred maintenance. That could be a new concept for many of our people, our listeners in Europe. So could you maybe just unpack that and what you mean by that? Because it is something that's absolutely key.
Like what deferred maintenance means?
Correct.
Deferred maintenance means anything related to the property that that doesn't need to be replaced today because it's still functioning and it's okay, it's fine, but you know that because it's aging or weathered or old, that it will be required to be replaced in the next few years. A good example is a roof. You might purchase a property with a roof that doesn't leak, it's in good condition. You can have a professional look at it and they'll tell you, well, you've probably got another 3, 5, or 7 years left of life expectancy on that roof. Well, it's fine. It doesn't need to be replaced today. You don't need to spend the capital to replace it, but you do know that because it's 20 years old, it'll need to be replaced in 5 years, right? So that would be a deferred maintenance item. That's more of a capital expenditure. It's kind of a big ticket item. A simpler example might be carpeting. Carpeting is probably the most common example. Carpeting might be fine the way it is, and it can be cleaned, and you could rent the property. But you know that when this new tenant moves out in 1 year, 2 year, 3 years from now, the carpet is going to be need replacement. So that is a deferred maintenance item, a smaller ticket item, but still something that's deferred maintenance.
Okay, perfect. Appreciate you clarifying that, because especially for a lot of our listeners in Europe, that may be a concept that's new for them. I know a lot back stateside, it's pretty well known. And I know you're also, Marco, you're really passionate about the helping to educate, and there's this term inflation, right? And I know we continue to print more money every single day, but there's something that's special about real estate and how it can help around inflation. Maybe you could talk to us a little bit about that.
Yeah, so inflation is simply the prices of goods and services going up, but really it's not that the price of the value of items going up. It's really the purchasing power of the dollar or the euro going down. So when the purchasing power goes down, that note you carry in your wallet, the number on that doesn't actually change. What happens is the prices you see at the store, at the pump, wherever you go, it's going up because it's just reflecting the drop in the purchasing power of the currency that you hold in your wallet. So the beautiful thing about certain investments like real estate, for example, is they're an inflation hedge. They actually keep pace with inflation. So the value of real estate, everything else being equal, doesn't actually change. If you purchase a $100,000 3-bedroom home today, and in 10 years that property is worth $150,000, the intrinsic value of that property has not changed. It's still a 3-bedroom home with the same square footage. It's doing the same function. But because it's now $150,000, what it's showing you is that the purchasing power of the dollar, whatever you bought it in, has gone down. So the beautiful thing about real estate is it keeps pace with that inflation. So you actually don't lose purchasing power in the dollar as you hold investment real estate. The same thing is true over the long term with precious metals like gold and silver. That's the whole idea of having precious metals. But the other nice thing about real estate, well, there's 2 more huge benefits. Number one, as the years go by and inflation continues to inch its way up, whether it's 2% a year, 3% a year, or more, what happens is your rents will go up. So not only does the value Well, let me take that back. Not only is the market value, what I call market value, I really should be saying price, but this is what people call it. They call it the market value of the property, but the price of the property goes up. Let's call it market value. The rents go up. So that means your monthly cash flow goes up. So that's the one nice thing. The other thing too is if you have financing on the property, and this is the thing that most people don't talk about, which is a beautiful, beautiful secret, if you will, the value of that mortgage diminishes. Because if you have let's say you have a $100,000 mortgage on a property, okay? This might be a little bit different in Europe, but when you have financing on a property, the value of that loan diminishes every year. Let's say inflation is 5%. Well, every year that $100,000 loan is going to diminish by 5%, and you don't have to do anything for that. See, the cool thing is you're paying off that mortgage every single year in the same fixed dollar amount. That doesn't adjust for inflation. So the beautiful thing is that every year you're paying off that mortgage in cheaper and cheaper dollars. It's becoming cheaper and cheaper to pay it off. And so in 15 years, that $500 mortgage payment is going to be laughable. That might be a Starbucks coffee. So
that's beyond gold. That's platinum. Just the tip. That's a major concept, and something that definitely, if you didn't hear it the first time, you need to listen to it again, because Marco's just shared something that's absolutely key, especially as it relates to using leverage, investing in your properties. So thank you for sharing that, Marco. Another thing I know that you are, I mean, it's just something that's close to your heart, something that you and your team are excellent at. It's when you're looking at cash flowing assets. I mean, you're across a number of different markets all across the United States. I guess for those that are interested in understanding, what are some of the key criteria that I should think about when I'm looking for a cash flowing asset, regardless of the specific geography? Could you maybe help us educate us on that?
So are you talking about the property itself, or are you talking about the market? I assume
Really
you're
more
talking
about
the property.
Well, more about the location. Sorry, more about the location versus the specific property.
Well, so when I look at markets, the key thing I'm looking for, when I say a market, I'm talking about either a city or a metropolitan statistical area, which is larger than the city, usually includes multiple suburbs, which are cities themselves. So you take a look at New York. New York is not just a city. It's made up of a whole bunch of suburbs all around it. Same thing with Los Angeles or San Diego or any other big city. The problem with these big cities, though, is they're overpriced. They're very expensive, and it's hard to make the numbers work. So people from Europe thinking about investing in the United States, the last thing you should be looking at are what I call tier one markets, which are these big, well-known markets, whether it be, again, New York, Los Angeles, Miami, San Francisco. These are very, very overpriced, high downside risk, which is a place you don't want to be, and the numbers don't make sense. So you're not going to get a rate of return, even if you have positive cash flow. But the secondary markets, like places like Kansas City, Indianapolis, Jacksonville, Florida, Memphis, Tennessee, to a large degree the outskirts of Chicago, Illinois, these are markets that have a large population, a very broad economy, a good population base and economic base. It's not just based on tourism or manufacturing or any one thing. So that's an important factor. But the two key things about a market are job growth and population growth. If you have population growth, you have upside pressure on the demand for housing. You need rentals and you need home sales. So you want population growth because it creates the demand and the need for additional housing. And when you have demand, and especially if it outpaces supply, you have that pressure for price growth. So that's also a form of inflation, by the way, but that's driven not by the loss of purchasing power. That price growth is driven by demand in the market saying, hey, there's more people who want this stuff than we can actually put into this market. And we see that happening in a lot of markets all around the United States right now, which is another of the many reasons why investing in the United States in real estate makes so much sense today. And that leads to the second point is a lot of that population growth is driven by job growth. So when you have a vibrant economy, now we can't speak for the last few weeks here with this whole coronavirus thing going on because everybody's on lockdown, including you.
Yeah.
But when things are normal, what we have are, we have a very vibrant economy. We have some of the lowest employment rates, or up until recently, we've had historically lowest unemployment rates in 50 years. So when you have a lot of jobs, you have people moving into markets because they're coming in for the jobs, they're paying jobs, they're expanding, they're moving, whatever. So jobs and job growth are the two key things with a market.
Okay, fantastic. So jobs as well as, excuse me, as population growth and
Yes.
job growth. And I know one of the things that we look when we're talking about population growth specifically is the net migration, meaning that there are more people going to a specific location versus leaving, the net of the goers and the leavers. The
Yes.
people that are
Yes.
entering and the people that are leaving.
Exactly.
A little bit tongue-tied there. That's all right.
You got it.
So listen, so Marco, I mean, you have shared so much knowledge with us. I mean, in terms of being able to understand who are some of the different key core members of the team, who are the team members that are coming off of the bench. You've helped us to understand how you look at a specific opportunity. You've also helped us to understand when you're looking at market dynamics or location dynamics, also some of the different things that we should be thinking about when we look at investing in an asset, right? Whether we're doing that actively, whether we're doing that passively. And you've also helped us to understand more about the concept of how you define what a turnkey opportunity is. So this has been a really wonderful conversation, action-packed, actionable items. And I'd like to be able to start to wrap up the conversation. And I'd like to ask you our going long final 3 questions of the day, if you're ready.
I'm ready.
All right, perfect. Awesome. So, Marco, the very first question is, what is your favorite European city, either that you visited or you have on your bucket list?
I've been to many times Florence, Italy, or in Italy, they call it Firenze.
Yep.
Beautiful city. I love that city. I'm sure you've been there.
I have, and I love it. I love it. It's wonderful, wonderful, especially if you're there in like the early fall. It's fantastic. It's fantastic.
Cool.
Next question. What is the biggest mistake that you have made professionally? And most importantly, from that mistake that took place, what was the learning that you've now put into place?
I've made a lot of mistakes.
Join the club.
I don't know which one's the biggest one. But I'll tell you one that I have learned over time, just through experience, and it was really what we've been talking about, is picking the right market, and more importantly, picking the right neighborhoods. Because there was a time where I was investing based on price. I wanted to buy as cheap as possible, so I ended up buying cheap property, and I'm talking properties that were like 20, 30, 40, 50,000 US dollars for essentially what used to be $150,000, but there was a reason why they were so cheap, and still to this day are so cheap, because they were in very what I'll call C and D class neighborhoods. Very, very low income demographic. Not a lot of jobs, a lot of unemployment, just very down type of neighborhood. And the thing is I was buying based on price. The numbers on paper looked great. And that was my mistake, is I was being mesmerized by the fact that the cash on cash returns looked good and the cash flow looked good. But in reality, those properties would never appreciate. And I was having more problems with tenant turnover and just management issues than anything else. So neighborhood is very, very important.
Okay, fantastic. So you've taken that, looking on the investing maybe in the lower or less dollar, focused more on the amount that was invested, and since then you've realized that you need to take a look at the bigger picture. So okay, perfect.
Yeah, well, yeah, and you really need to take the neighborhood demographics into consideration. Yeah.
Okay, fantastic. And then wrapping up with the last question, which is what is your favorite book, or the book that's made the biggest impact on you and lesson learned from the book?
There are a lot of books that made a big impact on me, but I think the one that you probably hear more often than not, and I have a story with it, which I won't get into, is really Robert Kiyosaki's Rich Dad, Poor Dad. It's one of many books that have had a big impact on me, but coincidentally, that was actually the book that I was glued to on a train from Rome to Florence.
Really?
I couldn't put the book down, and my wife is like kind of looking out the window at all the beautiful scenery, and I'm sitting there on this train with my head in a book. So Anyway, that was a change in how you think and your paradigm on money. So.
Okay, fantastic. Well, that little purple book has made an impact on millions of people around the globe. So that's another
Yes.
one for Rich Dad Poor Dad. So, listen,
Yeah.
Marco, this has been phenomenal. It's really, really a pleasure to have had you here to share with the Going Long listeners and viewers. And I'm sure that so many of them, just like me, want to know, like, how in the world can I get in touch with Marco? I want to find out more about what he's doing, learn more from him. So could you help everybody understand what is the best way to contact you, your team, and to be able to, be in touch with you?
The best way to get a hold of me and my team are through our two websites. Our main website is noradarealestate.com, NORADA. That's where we put a ton of free content, free information, downloadable reports and guides, and dozens and dozens, if not hundreds, of investment properties available in different markets around the United States. So noradarealestate.com. And then the sister website is passiverealestateinvesting.com. And that actually is the home of my podcast. And it's the same title, Passive Real Estate Investing. So that's it.
Fantastic. So we're going to make sure that we include both of the links in the show notes, or if you're watching us, they'll be in the notes just below. If you even have the smallest inkling to understand more about investing in a passive way in the U.S. market, definitely need to pick up the phone. Definitely need to get on the internet, reach out to Marco and his team, and find out more about how they can help you. So, Marco, it's been a real pleasure, man. Thank you so much, and I hope to have you back again.
Billy, it's been an honor. Thank you so much.
Thanks so much. Take care. Wow, don't you love hearing from top-notch experts in the field? You know, when I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long-distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.